Hello everyone. Today we are going to study about section C, which is performance management. To manage performance, we first need to know and analyze the performance. And how to analyze? By comparing expectations versus reality. Just like those funny videos where the reality is different than the expectation. I know you enjoyed them. The same could happen in business, and such differences are known as variances. In the last section, we learned how to make budgets. Those budgets where our annual targets are annual expectations which we keep at the beginning of the year, whereas the reality we get to know at the end of the year. Let's dig deeper into expectation versus reality. In terms of budgets, my expectations could be called as static budget and reality could be called as the actual budget. Hence, comparing the static budget with the actual budget will give the variance. That's nothing but expectation versus reality again. Let us begin with the income statement. Now, this income statement shows us our operating income or any other income. So, how to make this? You just need to determine how much were your sales, and out of those sales, how much expenses you did, and in the end, what was left is nothing but the income. So that's how the income statement is built. So here I'm gonna make the income statement in terms of actual budget and also in the terms of static budget. On my left, I'm writing actual budget, which is the reality, the current situation. And on my right, I'm writing the static budget, which was the expectation at the beginning of the year. Let us say in the beginning of the year, we decided to sell 600 units for rupees 5 each unit. Then my sales revenue would be 600 into 5, that's 3000. But that was my expectation, and the reality can turn out to be different. So let's say the case turned out to be different, and we were able to sell only 500 units just for rupees 4 per unit. So 500 into 4 turns out to be 2000. So we expected 3000, but in reality we sold only the amount equal to 2000. So the difference between this 3000 and 2000, that is 1000 rupees, would be called as the variance. Now because this variance is arising in sales, it would be called as sales variance. Now if I ask the question that how did this 1000 rupees variance arise, then just by looking 2000 and 3000 you might not be able to say the answer. But if I break down 2000 into 500 into 4, and if I break down 3000, that's 600 into 5, then you'll be able to figure out the exact reason why the variance has arisen. So you can see clearly that the variance is not just arising because of the change in number of units, it's also arising due to the change in the selling price per unit. That means there could be situations where sometimes the variance arises due to the selling price per unit, and sometimes it arises due to the units differences, and sometimes it could be both. And you were able to determine it only when I broke it down. If I just say 3000 minus 2000, 1000 is the variance, you will never get to know this 1000 is coming out of what. So that is the reason we build one more budget that's called as the flexible budget, which takes one element from the actual budget, another element from the static budget to find out the exact reason why the variance is arising. Now let us say in the flexible budget, I am taking units as of the actual budget, which is equal to the actual budget, and the selling price per unit I'm taking equal to the static budget. So I'm taking 5 from static budget to be selling price per unit, and 500 from actual budget to be the units sold. Now if I compare the actual budget and the flexible budget, I will get to know that the 500, that is the units sold, is same in both. So the variance cannot possibly arise from this. The variance has to arise from the second element, which is price. And that's what happened here. The difference is arising because in the actual budget we are selling it for 4 rupees per unit, but in the flexible budget we are selling it for 5 rupees per unit. So the 1 rupee difference per unit, when multiplied with 500, it could be 500 rupees of variance. Now this 500 rupees of variance is arising not due to units, it's arising due to the price. So I could say that this is the sales price variance. And when I look on the other hand, when I compare flexible budget with the static budget, the price is same, 5 rupees per unit in both of them. But what differs is the number of units. In flexible budget I am selling only 500 units, whereas in static budget I am selling 600 units. So the 100 units difference multiplied by 5 will give you 500 rupees of difference. Now this difference, this variance is not arising due to price because price is same here. It is arising due to the units sold. Now I can call this variance as sales units variance. Now as we just saw that sales price variance is 500 rupees and sales units variance is another 500 rupees, we can conclude that the total sales variance is 1000 rupees. And if this variance is good for the company, it would be called as favorable variance, and if it is not good for the organization, it will be called as unfavorable variance or adverse variance. Now in the income statement, after sales comes the cost that we have spent, starting from direct material, then direct labor, then variable overheads. Now direct material, direct labor and variable overheads all are variable costs, and when we remove variable costs from sales, the result we get is called as contribution. It is called contribution because it further contributes towards the fixed cost and profit. After contribution, we are going to deduct the fixed cost, and after deducting fixed cost from contribution, whatever is left is known as operating income. So this is our income statement. The same for actual budget, fixed flexible budget and static budget. And what we just did with sales, that is the variance calculation, we can do the same for direct material, direct labor, variable overheads, fixed costs. So if we are calculating the variances for cost, it will be called as cost variances. And if we are calculating it for sales, it will be called as sales variance. Let us start with the cost variances. The first cost in the cost list is direct material. So let us first calculate the direct material variance. I'm gonna do the same thing that I did for sales variances. I'm just gonna take the actuals, the standard or static, and compare them and find out the variance. And to find out the reason for the variance, I'll build a flexible budget in between, taking one element from the actual, another element from the static. So let's do it. How will you get to know the cost of direct material? Obviously units into price, correct? So if we are talking about the actual price or actual cost of direct material, then the formula would be actual price into actual quantity. And if you are talking about the static cost or the standard cost, then it will be standard price into standard quantity. Now the difference between these both, I'll denote it by AP, AQ, SP, SQ, alright? So the difference between AP into AQ minus SP into SQ would be the direct material total variance. So let's take an example. Let's say we thought in the beginning of the year that our direct material cost would be 1 rupee per unit, and the number of units we expected were 600. So 1 into 600, the direct material cost that we expected was 600, whereas the actual story was different. In the actuals, what happened is we were able to purchase the direct material in 0.5, and we purchased only for 500 units. So 500 into 0.5 is 250 rupees. So the standard cost of direct material says it's 600 and the actual cost says it's 250. Now the difference between both is 350. Now, to understand why this 350 is arising, we need to break it down. And the best possible way to break it down is making another budget, which is called as flexible budget in the between. So, taking one element from actual, another element from static. So, let's say the element that I am taking from actual budget is the quantity, and from static budget, I am taking the price. So, the flexible budget becomes AQ into SP. Now, a question might pop up in your head that why I'm always taking the quantity in flexible budget from actual budget. Why am I not taking the actual price? Well, the answer to that is that quantity is in our control. It's an internal matter. So we can be flexible about it. But price is not in our control. It depends on market. That's the reason we cannot be flexible about it. That's the reason we take the standard price. So I've taken 500 units from the actual budget and 1 rupee cost from the static budget. So 1 into 500, my direct material cost in flexible budget is 500. Now the difference between actual and flexible is 250 rupees. That means this variance is arising due to the price. So it will be called as direct material price variance because the units are same. So it cannot be because of units. It has to be only because of price. But when we see on the other hand, flexible budget compared with static budget, the difference is of 100 rupees, 500 versus 600. So this difference, this 100 variance is arising not due to the price but due to the quantity, the units. So it will be called as direct material quantity variance, or you can even call it as direct material usage variance. So if you add both direct material price variance and direct material usage variance, you get the total direct material variance. Now, how to decide whether these variances were favorable or unfavorable? Let's see the direct material price variance. The flexible budget said that the standard price should have been 1 rupee, but in actual, the price was only 0.5 rupees. That means that the target was given to get the material in 1 rupee, but we got it for 0.5, which is good for the company that we got it in a cheaper price. So this variance would be called as a favorable variance here. On the other hand, we were supposed to use 600 units, but if we see the flexible budget, we used only 500 units. That means we have used 100 units lesser than the target. That means the quantity variance is favorable. We are not using more units, we are using less units here. Now let us discuss the second cost on our list, that is direct labor. Now, how would you determine the cost of direct labor? Obviously, you will not be taking price into quantity. You don't hire laborers in terms of quantity or in terms of their weight, correct? You hire them in terms of the hours, and you pay them actually in terms of hours. So I would say direct labor cost formula would be rate per hour into number of hours. Now let us quickly make the budgets, actual budget, static budget, and the flexible budget. The same rule applies. The same thing that we did for sales and direct material, we're going to do the same for direct labor. So in the actual budget, I'm taking actual rate into actual hours, and in the static budget, I'm taking standard rate into standard hours. And in the flexible budget, again, one element from actual, another element from static. So always quantity or hours is in our hand and not the price or rate. So that's why in flexible we can only be flexible about our hours or quantity. So here I'm going to take actual hours from actual budget and standard rate from the static budget. So let's do the math for actual budget. So let's say we are paying 1 rupee per hour and we are making them work 500 hours. So 1 into 500 is 500 here. And in case of static, we thought of paying only 0.5 per hour, and we thought of using let's say 600 hours. So zero point 0.5 into 600 would be 300. So the standard that we have given, the target was 300, but the actual that we achieved was 500. So here's a 200 rupee variance in both, and that's not favorable. Why? Because we thought of spending only 300 on labor, but ended up spending 500, means we have spent more. That's not favorable for the company. So the total direct labor variance would be 200. Now, to get to know that what exactly are the factors for the variance, then we can break it down with the help of flexible budget, of course. So we are taking, let's say, hours from the actual, that's 500 hours, and standard rate from static, that's zero point 0.5. So 500 into 0.5, we're getting 250. So now if we compare our flexible direct labor budget with the actual direct labor budget, 500 versus 250, the difference is 250. Now this difference is arising due to actual rate and standard rate differences, because the actual hours are same in both the budgets. Same goes in on the other hand. 250 versus 300, the difference is 50. Now this difference 50 is arising due to hours and not due to the rate. Now we are going to discuss variable overheads, and the same concept applies in variable overheads. Now sometimes they could give you in terms of units into price, or sometimes they can give you in terms of hours into rate, because overheads could be indirect material, that could be units in price, or it could as well be in terms of indirect labor, which could be hours and rate again. But the game is same for variable overhead as it was for direct material and direct labor. The same we are going to do: actual budget, flexible budget, and static budget, and then comparing between them, finding out the variances. So let's not waste our time discussing it again, because we have already gone through it, because we have already gone deep into it. Now after deducting the Now, after deducting the costs from the sales, what we get is contribution, and you can find the contribution is different in actual budget, in flexible budget, and also in the static budget. Overhead variances is quite a different game. There could be different approaches to it, like the four-way variance approach, the three-way variance approach, and the two-way variance approach. Let's begin with four-way variance approach, where I have divided the variable overheads and fixed overheads in four quadrants. All right. Variable overhead is quite easy to understand, because it is similar to the labor variances or the material variances what we have learned before. It's gonna follow the same rules, that actuals comparing with the static, in between coming flexible, having one element from actual and another element from static. So let's first discuss variable overheads. AH into AR, that's actual hours into actual rate, if we are talking about variable overheads, which is in terms of hours and rate. If it's in terms of material kind of a thing, then we are going to take actual quantity and actual price. So regardless, AH into AR, then let's take the standard SH into SR. Now this will give us total direct variable overhead variance. In between, we have to draw up a flexible budget, which is AH into SR. Now this AH is common in actual and flexible, and AR SR differs. So that means the variance is arising due to the rate or the price. Now this would be called as the overhead spending variance. The difference between AHSR and AHAR would be overhead spending variance. On the other hand, we have AHSR compared with SHSR, which gives us the overhead efficiency variance, because here the difference is between the hours, not in the rate or price. If you add up both efficiency variance and spending variance, you'll get the total variable overhead variance. Now let's discuss the next phase, which is fixed overhead variances. Now in fixed overhead, it's quite difficult to break down in terms of rate and hours or price or quantity, because usually overheads is not broken up. It's usually a certain amount. For example, let's say rent. You don't pay rent in terms of units or hours, isn't it? It's kind of a monthly rent, which is a stable amount, which is a total amount. So breaking that down is quite difficult. So similarly here, that's the same problem, but in some cases we can break it down. Anyways, let's assume that we are not able to break it down. So actual fixed overheads, what we get to know in the end of the year, and the standard that we expected long back, that we have given a standard target to our employees. So standard fixed overheads compared with actual fixed overheads gives us the total fixed overhead variance. Now, to understand why this variance is arising, again we have to make a flexible budget kind of a thing in between, that would be called as the budgeted overheads. Now the comparison between actual fixed overhead versus budgeted fixed overhead would be overhead spending variance, and the comparison between budgeted overheads and standard overhead would be production volume variance. Now let's just understand the reason behind this. Now, before getting into the skin of this, let me explain you the differences between the terminology. Whenever I say standard, static, absorbed overheads, applied overheads, all these terms means the same. But what does not mean the same is budgeted. The term budgeted is specific for a period of time. Like in short run, I can say that usually we use the term budgeted, but in long run we tend to go for the standard term. Now, in the long run, standard and budgeted is the same, one and the same, but in short run, the both mean differently. What budgeted means is just an expectation, whereas the standard means it's a target, it's a requirement. So it's not just an expectation, it's a order to the organization. So that's the basic difference between them. So here in fixed overheads, the variance that we are going to calculate is actual versus budgeted, that's overhead spending variance, then budgeted versus standard, that's production volume variance. Now the same analogy could be used that we've been using, that the spending variance is again related to price or rate, even if we are not breaking it down, and the production volume variance is again related to the volume. So it could be hours or the quantity, right? So this was our fixed overhead variances. Now if we combine both of them, variable overhead variances and fixed overhead variances, we can divide it in 4 quadrants. Like you can see on the screen, that overhead spending variance for variable overhead and overhead spending variance for actual overheads. Then comes overhead efficiency variance in variable overhead. Then comes production volume variance in fixed overheads. So I've divided into this 4 numbers. All right. Now if I'm going with the four-way approach, then this is how I'm going to calculate it. But if I'm going with the 3-way approach, then I need to combine 1 and 2. That's spending variance of variable overhead with the spending variance of fixed overhead, because they belong to the same category. So 1 or 2 is now a single category. Then the second category is 3 and the third category is 4. That's why this is called as the 3-way variance approach. So 1 plus 2, 3 and 4. Now we can also put it in 2-way variance approach, where we can combine 1, 2 and 3 in a single row and keep 4 separately. So how are we able to combine 1, 2 and 3? We are able to combine them on the basis of their feature, on the basis of their nature. The nature of them is they are controllable. All these variances, the spending variances of variable overhead, the spending variance of fixed overhead, the efficiency variance, all these are controllable. So we can put it in a single head named as controllable. Then production volume variance is something which is not controllable. Reason for that is it really depends on the market, because when we do production we actually base it on sales, and sales is predicted on the basis of sales forecast, that is somewhere it's external. So that's the reason it's not gonna be the same, or it's not going to be the controllable factor here, so we'll call it as uncontrollable here. So friends, we have completed direct material variances, direct labor variances, variable overhead variances, and fixed overhead variances. Now before going further, I would like you all to solve some problems.